Okay, just before coffee, what's better than some economics? Delighted. We're going to now look at how macroeconomics drive aircraft finance. I think in the past, we've often had an economist up here predicting and going on in the future. And what we wanted in this session is actually say, does it make any difference? We've got three fantastic experts, Christopher Lee from First Source Bank, Rami Sidholm from PNC, who's first on stage, and then Vivek Kaushal from Global Jet Capital. You're looking like you don't want to be up here, Rami. You're like, Rami, you're walking. Okay. I don't think any of you need introductions. We're going to go straight into it. Let's do some economics 101. Vivek, how closely correlated are interest rates and demand for aircraft finance?
So in my opinion, and we've seen this fairly often, it's not so much the absolute level of rates. It's the direction of travel. And whenever there's uncertainty, people take a step back, and oftentimes it's with good reason. You look at the last Fed cycle, it was the steepest cycle since the 1980s, right? And so people were justified in just taking that step back, and it just so happened it coincided with just this spike in aircraft values. So anybody in our client list that was experienced buyer just said, you know what, I'm just going to sit this out for a little while. And all changed in 2020, late 2023, 2024, and we can talk more about that, but that's sort of what we saw.
Rami?
So it's an interesting question, because the first question that we receive from any customer is, what's the rate today, right? And so to what Vivek just said, if you look at 2021 when lending was robust, right, the 5-year swap was about 88 basis points to 120, right? And the 5-year swap is really the exchange between variable to fixed in terms of institutional lenders. And so if you look at that today, the rate is 3.92, right? So it costs more. So that's the first question. Now, what we also know is that wealth has grown quite a bit. So the billionaires have generated in the North American market about 1.2 trillion, right? So cash is still king. So we compete against cash most often and not competing lenders. So it's a mix.
Chris?
Well, the answer really is it depends. It depends on the client. I think as interest rates move up, you have cash-sensitive businesses like 135 operators that are going to be hit harder than a wealthy individual or a small entrepreneurship. But we saw a couple of examples where, as rates were going up, we saw an increase in volume. And what we saw was two things were mainly driving that. One is there was this impression from our clients that they wanted to beat the rates going up too far by locking it in. So there was a rush to lock in fixed rates as rates were creeping up. So that was part of it. But there was also, and you read about this in the journal, about this margin compression that was happening with banks. And what that translates to is a better deal for our client. So let's go back to 2020. Recall what you were getting on your cash in 2020. It was, for a client who has a lot of cash, they weren't getting much, so they were deploying it where they could to get a better return. So we saw a lot of clients choosing to go with cash back then because they weren't getting any return on it. Fast forward a few years, people are getting 4.5%, 5% on cash. The delta between what they were getting at 0% on their money in 2020 when rates were 300, let's call it 300 bips. Fast forward to when rates on their cash were 5%, but they could get a lock at 6.5%. That delta shrunk. And so the cost to them relationally was lower, even though rates were going up.
What's your rough split between fixed and floating rate deals, Chris?
I can't really say.
Is it, but do you see, okay, does anyone else want to? Vivek, you'll answer that.
Yeah, we do a lot of leasing, and leasing is typically fixed rates. I would say the vast majority of what we do is fixed.
I'd say about 40% floating.
And have you seen a big change? Did you see people wanting to lock in fixed rates?
I think mostly fixed, Another way to caveat the fix is to do a swap, in fact. But we're seeing more fixed rate in this environment. That might change as fluctuation in the rate environment continues, particularly with the Fed funds cut last week, anticipated of like 83% of another cut in December. So as you start to see the yield curve change, and I think the 10 and 2 is about 15 basis points between the two, I think that fluctuation may cause more variable interest.
And with a swap, you tend to have a break
That's right.
fee, so that's slightly less. You lose flexibility with a swap.
There's some of that, yes.
Vivek, the mood, you're saying it's direction, it's going down. Are you seeing an increase in finance because of that? Demand for finance?
So here's the thing, because we do a lot of fixed rate business, fixed rates the Fed really isn't in control of fixed rates beyond a point, okay? It's the market that determines fixed rates. And once it was clear that the Fed was getting to the top of its cycle, guess what? Fixed rates actually started to come down early in 2023, like second quarter of 2023, you started to see fixed rates come down. And so that's been happening in our market for the last 18 months. In fact, of late, the direction of travel has been in the other direction. Actually, rates have gone up a little bit. And then frankly, when you think about, the fiscal objectives of, the new administration, and I don't think that fiscally this administration would have been that different from a different administration, there is some risk there to rates continue to sort of trend higher, especially on the fixed. And to some extent, actually, it kind of makes sense, and it's good from a marketplace perspective because the interest rate curve should have an upward slope. That's what puts the right incentives in place for borrowers and lenders, and to have that to some extent is actually preferable from our perspective. We are a pure play financier, and when you get the benefit of that steeper interest rate curve, it actually helps business.
Chris?
I mean, I'd have to agree with that. That's what we're seeing too, as far as fixed rate. We do a lot of fixed rate business, but I think it would surprise a lot of people when you read in the news that rates are coming down and you see prime rate recently adjusted, that the fixed rates are pretty stable, in some cases even going up. So yeah, we see that a lot.
In the last few years, you've all talked about it. We saw people being put off. Are you expecting more refinancings? I know we've talking about rates, but are you seeing more refinancings? And also, not every manufacturer's raising their delivery at the moment, their numbers. Chris?
You want me?
Yeah, sure.
No, please.
Yeah, we're not seeing any more refinances than normal. It's a part of owning an aircraft for a long period. Typically, an ownership life cycle would be 3.5 years on average for us. But as clients own aircraft for longer periods, a typical note for us might be 5 years with a longer AM. So they're going to be coming back to us no matter what. And we're seeing a normal cycle right now.
Are you seeing a normal cycle for that?
So what we're seeing is actually, I don't think that people are exactly kind of put off. Actually having an 18 to 24 month sort of delivery cycle actually aligns well with people's planning processes. They don't want to buy a $50 million aircraft on impulse. They want to plan for it, they want to pay for it over a period of time, and they want to bring it into their organizations when they are ready, right? So they want that planning horizon. There's a little bit of upward pricing pressure on new delivery prices, but when you're sort of running a business and you're seeing all your inputs go up like mid single digits, high single digits, a 2%, 3% inflation coming from your OEM on an aircraft that you're purchasing doesn't look all that terrible. So on balance, I'd say that, look, if somebody is in a real hurry, they're going to look to the pre-owned market. And that actually is a good dynamic too. You're seeing actually a little more supply of those younger aircraft that people want to get into. So at this moment, it's very balanced. If we're seeing anything, we're seeing like people come to us and say, look, I've placed the order for the aircraft. My lease is coming up next year. The plane won't come for another 12 months. Will you work with us? And of course, the answer is yes. We'll work with them.
So I'd say I think there's two categories, planned and unplanned. So planned is, reaches maturity, and at that point, there's a refinance opportunity if they're going to retain that aircraft. Unplanned, I'd say, has been curtailed because of low inventories and I think an unattractive yield market, right? So in terms of early payoffs, and our portfolio churns typically like 3.5 years. There's usually a change in the aircraft or mission. And so that had historically lent its way to refinance or a replacement aircraft. And we've seen that sort of come down quite a bit the last few years. But, in terms of planned, it is what it is. At 5 years, there's going to be some sort of lending change or request.
You do pre-delivery payment financing, don't you?
We do.
In fact, I think everyone does on this.
Yeah, we do.
Yeah. With bigger lead times to get aircraft, are you seeing an increased appetite for pre-delivery?
I would say yes. We're actually marketing quite heavily that we have the capital to help that temporary financing, and it gives a higher propensity for permanent financing should you get involved early on. So it's definitely of interest, and I think the further the deliveries out or the unexpected delays continue, I think there is more attraction to that.
But you don't insist on having the term loan at the end of it. You just encourage.
Yes.
Chris?
Yeah, so we decide early on if we're going to do a permanent financing, and that's something we structure into the deal. So those prepayments or step payments, progress payments, those are all part of an approval that happens at step one. So we know we're going to get the deal at the end. That's how we structure ours. But to your question about demand based on availability on the OEM's backlog, I think what we're seeing now isn't a change in demand, but maybe a change in the client, because what we've seen historically towards the end of the year, Q4, there's a lot of rush amongst small business owners and entrepreneurs that are motivated by things like accelerated depreciation, and they're not the best at planning 3 years out. But corporations tend to do that more, and I think we're starting to see that. And there's another macro issue here with the OEMs, and that is if you go back to 07 and 08, you saw a lot more speculative orders in the order book. And after that was flushed out in 08, I think the OEMs have done a very admirable job with their contracts in getting more down payment and higher prepayments leading up to delivery.
PDPs, look, we think of PDPs as an integrated solution for our customers. We're interested in the relationship. So from our perspective, doing an 18-month PDP makes no sense, right? We're interested in building a relationship with the customer and, therefore facilitating the PDP as a part of their overall acquisition plan. And, we're seeing, especially internationally, there's a lot of demand. That market is not well served in terms of progress payment financing. There's not a lot of different options that people have. And there we can, work with the customer from the get-go and really become part of their aircraft acquisition journey at the outset.
Remy, do you think the biggest driver for PDP finance is just taking away hassle for the customer?
I think so. I mean, that certainly plays into it. It's no different than, building a home, right? There's more I's, there's more T's to be crossed, I's to be dotted. And I think having a lender that plays into the space, and, we're a self-contained business group between a very large P&C bank institution. And so I think there's a lot more I's. And so, you've got to talk to the lender along with the borrower. And so that certainly plays into it. But I think the other part of it is just simple working capital solution and sort of managing that, right? Why put out capital to an aircraft that's being built when you can borrow it? And so, that's the simple answer. I think there's some other tangential, benefits to doing it that way.
And Vivek, the OEM attitude to PDPs,
we worked with all of them. I think it's been a fantastic experience. We've got sort of a broad array of solutions, even within the PDP world, that are geared towards different outcomes that our clients want. And All the OEMs are familiar with them. They work with us really well. It's very seamless.
And it's a lot easier than doing PDPs to Hawker back in 2010 or something.
2010, yes, different time.
And Chris, we talk about, the OEMs are doing a great job. They've all got great book to builds. And buyers are just happy to take the inflation. They're happy to say that, I'm going to have escalation in, well, not happy, but I guess because every OEM's got a backlog, you just live with it. If you want an aircraft, you pay it. Is that the attitude?
Yeah, I think it is, especially when we go back to who's making up the backlog. So a corporation is going to be able to not just absorb, but plan a little bit more strategically. It's that more emotional, tax-driven, accelerated depreciation-driven buyer that's going to be dropping out of the percentage makeup of that order book. But we still get it, and order books change. We work with all OEMs. Some we'll see there will be a spot that will open at the last minute. Strikes have, kind of lengthened the time for some of the deliveries that we were counting on for Q4, and we're trying to get those done. There's just a lot of variables that go into what's going to make that delivery happen or not. So we work with the OEMs and we work with the clients, and we try to minimize the damage that's done, especially on a tax-driven purchase if it falls out of the quarter. And the OEMs have done a really good job about finding solutions or finding an extra aircraft in that quarter to try to help that.
Would you welcome accelerated depreciation coming back?
For us, it's a wash. I mean, it's really, the industry calls it bonus depreciation, but it's just accelerated. There's no magic to it. I think we talked about 1031 versus accelerated yesterday, but I think you're going to see that there tends to be more of an impact for the people that don't plan out 2 years in advance. So for those buyers, we'll see more of an ask for financing from those when bonus gets renewed, or if it does. That's something we would expect.
Anyone else thoughts on accelerated depreciation?
That's the second, probably most popular question that we received. So I think there's a significant amount of appetite for it. I think the new administration, there's probably more excitement about that coming through. There was anticipation that was going to occur earlier this year, but did not happen. That was going to go retro. So I would anticipate that being a very good thing for our space.
Vivek?
So, the interesting thing is that you had 100% bonus depreciation in 2018 and 2019, and it just wasn't really a thing in our world if you go back to those 2 years, right? What really changed things on its head was, and when bonus became a thing was, 2020, 2021, was just this huge expansion in demand, right? And so the way I see it is that I think we're in a period of normalized demand. So does bonus depreciation help on the margin? It absolutely does, right? But will it be an accelerant in the way that it was in 2021 and 2022? I doubt it, to be honest with you.
So you're saying basically you need to have the threat of it being taken away?
Well, there's part of it, and then of course, like when we think about the user base between pre and post pandemic, we think the user base has expanded by like 15%, right? And before the pandemic, the user base was growing at like about 1.5% a year. So you got somewhere between 7 and 10 years of growth compressed into 3. That's what you saw, really accelerating things in a rush. And bonus depreciation, like I said, just became an accelerant on the fire. Now there's not that fire to accelerate, right, to the same degree. Will it be beneficial? Absolutely it will be. Will it turbocharge things the way it did? I'm not sure it will.
My theory is you just use it to lie to your partner and convince them that the aircraft doesn't really cost anything. And whether it's your business partner or your personal partner, and the whole thing is just, so if that helps sell a few aircraft.
I can't speak to that, to be honest.
We've got a question. With the residual value bubble deflating, how does that affect your willingness to lend? Or more specifically, Are you guys, you're always looking at aircraft values, but are you now starting to think now's the time to lower LTVs?
So, yeah, I'll take that. So we have a very stable business model, and it doesn't really change based on things like the bubble deflating or not. So one of the things that we're watching are the market is kind of individualized in the way that the collateral is looked at. So you have the big cabin, the mid-size, and the small, and you see different valuations getting hit harder at this time. And so we might take a look at an older aircraft that's a bigger cabin differently than we would a newer aircraft that's maybe a mid-size. Sure, we'll look at that, but it depends on the client, the credit, the collateral. So we look at the whole holistic picture in order to make that determination. But no, we won't look at a macroeconomic view of deflating values to determine LTVs.
So I think there's two parts to this question. The first is, are we open for business? Absolutely. Annually we'll originate anywhere from $1 billion to $1.5 billion. So about 20% of that, I would say, is in the lease category. And so as we look at our portfolio, it's roughly 600 to 650 aircraft, just under $4 billion. You look at the different types of aircraft and the models, and I think the way that you treat an out-of-production asset, the age of that asset, plays into the structuring. And so we really haven't changed our methodology. In fact, we've held true to it. I think there was a change or an impact of values probably in the 22, 23. We saw double-digit increases in valuation. And so at that point, we were very meticulous and judicious about how we were lending against that asset. I think now there's pockets of it. I think the super mid is still very, very popular. The older aircraft probably has the highest valuation, but we're pretty diligent about that. So it depends. Each transaction sort of stands on its own, as you heard probably Keith Hayes say quite a bit, but it doesn't change our methodology.
Yeah, so the interesting thing is that if you look at the industry, we were just incredibly disciplined. There was a time to lower LTVs, and it actually was 2 years ago, 3 years ago. And that's what we did as an industry, that we maintained that discipline. We didn't sort of get all giddy with this, shape of the depreciation curve, and we kept it sane. And so are we dropping LTVs? We're not dropping LTVs. We're being disciplined, like Rami was saying about, what we're financing and what the level is, but we put guardrails in place that kept us true through that bubble. We did sit out a lot of dances. It wasn't always pleasant, but we did it, and that's why we find ourselves in a market where things are favorable. We've got capital to deploy. We're doing it, and frankly, it's just a very balanced environment, is how we see it.
Yeah, from just a tactical level, going back 2 or 3 years, it was an easier conversation to have when people were flush with cash to ask for more down payment. So it didn't really affect us very much, and it made us stronger with our LTVs anyway.
Is that not your third question from customers? They do interest rate, they do bonus provision. LTV's not such an issue?
Does it come up? It could. I think we're pretty attuned to the marketplace. Wendy Preston's been doing it quite a while, and along with Rudy. And so, we're tied into the market. And if the numbers don't make sense to the customer, I think we can explain it to them and work around that. We're very sort of sensitive to that dialogue. But, having a fairly large book allows us to see a lot of transactions. And our network, obviously, many of you help us come to that determination. And so the one thing that we don't want to do is put a customer in a situation where they're upside down, right? And so having the tough conversation up front, I think, is the right move. Why be misleading just to get a deal done? It's not that important, not for us at least.
Okay, all three of you have been in the market for a long time. Vivek, you used to be chief risk officer looking for, what could go wrong. How are you feeling about the market now?
So, when we think about sort of OEM discipline, if you will, everybody talks about that, but what does it mean quantitatively? If you look at, where deliveries are at, and we focus mostly on the super mid to large cabin because that's where the biggest dollars are. The OEMs are delivering, I want to say, somewhere in that 4% of the installed base each year, a little over 4%. Now, if you allocate about 1% of that to category expansion, you're left with like 3 to 3.25%, which, effectively you do sort of the math on that, that's a 30-year useful life, okay? And you work with a 30-year useful life down to a 10% salvage value, you come up with a 7% depreciation rate. You stay with a 7% depreciation rate, you're going to be okay. There'll be, of course, as a financier, you've got to be attuned to the ups and downs of the marketplace and sort of stick handle at the right times. But if you don't get all giddy about it and you just look at the basic math, you're going to be okay. What does not OEM discipline look like? It's when that percentage moves up to 5%, 6%, 7%, which is what it was, in 2008, 2009, 2010. It was, up there in the 6s and 7s. That may work for a year. 2 years, you're starting to look, a little fat, and then 3 years, you're definitely going to have a dip. And that'll go on for a little while because it takes time to absorb an over-delivery cycle.
Rami, how are you feeling about the market?
I love the market. I think there's a lot of upside. I think 2025 looks fairly optimistic. I know that was one of the questions earlier. We know this space really well, and I think the players in this space do a good job, particularly the OEMs, of managing production. We've been able to understand what was going on in the pre-owned market back in 21, 22. We see what's happening now. I think the stickiness of COVID buyers has stuck around, which is really good. I think one of the sort of changes that could happen is perhaps some of those buyers move to maybe fractional or perhaps a move there to manage the variable cost in ownership. But most companies have been quite profitable, and really the rich have gotten richer. So I don't know that it's a matter of cost. I think there's more opportunity than there is less. And so in the North American market, I think we've done really well and hope to get more market share. So
I would agree. Also, it's not just about the facts and figures, it's about perceptions. And perceptions become reality, and our clients have given us strong feedback that there's more of a positive perception going into the end of this year and into next year than there was just a month ago. I think it's not just the election, but there's this stability that's going on in the markets. The Fed is probably not going to be lowering the rates as quickly as they maybe thought they were 6 months ago or a year ago. And so I think with that stability, that tends to lend businesses to make bigger decisions. It makes it easier for them.
Someone's asking, what keeps you up at night?
heartburn.
At this point, not a whole lot, but I will say that, look, you're sort of in a incredibly uncertain environment, particularly when you think about geopolitics or even sort of domestic politics and the behaviors and the decisions those things are drive. Those are forces that are sort of beyond our control, and how they interact in the future is complex. It's kind of hard to foresee. So what we're always doing is just thinking about, how do we make sure that we can protect the business on the downside, that we're taking sound decisions, that we have strategies that we can deploy when the chips are down and really protect the business in those downside scenarios. So nothing that keeps me up at night, but a lot that we plan for, just to make sure we're managing that. We know how to manage the downside when it does occur.
Millennials, just kidding. We are thinking about the next generation. We have people in our team that have been with us between 17 and 34 years. So trying to replace those folks keeps me up at night. It's not an easy thing in a relationship business to just hand off a book of business to somebody and then hope it goes well. So for me, I spent a lot of time thinking about that next generation. We're hiring, we're trying to make the next steps that will make a transition for the older generation to leave and for the newer generation to pick it up and run with it. So that's really what we're focused on right now, is keeping the business going.
You know, a serious response would be
your first one.
You know, I think the reality of it is we sell money for a business, right? And so you've got to be careful of who you sell money to. And I think bad actors that operate aircraft is a challenge. And so doing due diligence, really knowing your customer, the purpose of what the aircraft is for, is super important. The character profile is essential, particularly with an asset-based lending product, right, where you have no financial disclosure, very limited recourse. And so, you know, you've got to know who the borrower is. And so that's probably the item that worries me the most, because, you know, you could do 5, 10 deals and to recover one bad slip up. And so that sort of meticulous investigation upfront is worthy. But also, I think the network in the room helps us avoid those individuals, right? There's commonality in discussions that happen, and that helps, you know, ensure that you're not getting into an arrangement with a poor borrower.
And is that because you're worried about making a loss, or is reputation just as important?
I think it's both. You know, we want to be reliable. We want to be there for customers. But, you know, it's a nuisance to have one bad deal, right? There's a lot of effort that goes into remediating that problem. And so we don't want to be in a distressed asset business, right? There's people that are on that side that are much better at it than we are.
Heather's asking, where do you see the cash versus finance balance going over the next 1 to 3 years?
You know, we've sort of tracked the numbers on this. We think, you know, finance is anywhere between, you know, high 20s to mid, you know, early 30s. So pick like 30 to 32% of the market each year. I don't see that meaningfully changing, right? It does fluctuate a little bit. I don't see that meaningfully changing. From our perspective, that's like a $10 to $12 billion annual global transaction market. And what we're always doing is figuring out where in that marketplace we can add value. And, you know, it's a target-rich environment from our perspective. We see plenty of opportunity. I don't see the balance really altering meaningfully, but that's my perspective.
Okay, finally, on a scale of 1 to 10, with 1 being poor, 10 being great, what's 2025 going to be like for your business?
I'd say 12. I think it's going to be fantastic. And that's mostly because I'm going to give Keith Hayes a really high budget for next year.
Yeah, look, I think it's
not going to be a 1 for Keith. Enjoyment.
Yeah, it's going to be a strong year from whatever we can see. You know, we have a decent amount of backlog heading in, and fourth quarter is busy with transactions, talk of transactions for next year. So all that's telling me that we're going to have a lot to work on next year.
I need a number.
Oh, you need a number? Yeah, sure. I think we're going to be in that, you know, 8.
As the benefit of going last is I can top everything, so I'm going to say 14. I think the point is we're seeing a lot of great signs going into next year. There's more aircraft availability for clients to find good deals, and I think that's bringing some people that were on the sidelines back, and we're excited to see that.
Brilliant. Thank you very much. Jack Gilchrist has been making coffee and biscuits outside for the last 3 hours, so we're going to break for coffee. Thank you very much, guys.
Thank you.
It was really good. Thank you.